Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm Jack Bishop, investment manager based out of our Birmingham office, and this week I'm delighted to be joined by regular commentator and head of fixed interest research, Richard Carter, alongside Samir Shah, one of our fund research analysts covering the UK and global sectors. A very good morning to you both. So last week we had the Bank of England keeping rates on hold at 5.25% as expected. At the last meeting, the MPC voted 8-1 to keep rates on hold. However, this time we had the Deputy Governor, Dave Ramsden, joining the one dissenter at the last meeting to vote in favour of a rate cut, suggesting a more dovish stance from the voting members. There are two more inflation prints ahead of the next meeting, which are likely to determine if we do see that rate cut at the meeting in June. So the UK market, again, had another good week, building on the solid gains year to date. And then sticking to the topic of the UK, we had some encouraging news again on Friday. GDP data showed that the UK economy grew by 0.6% in Q1, meaning that we've now exited a technical recession and was the fastest quarter-on-quarter growth recorded since 2021, and driven by things such as car manufacturing and broad-based services. So a welcome boost for Rishi Sunak in what's been a tricky period, shall we say. So, Richard, if we focus on the Bank of England rate decision, first of all, it's probably no great surprise that we saw more vote for a rate cut, given the economic backdrop. What was the tone of the press conference from Bailey? The market seems to react quite positively to it. And what does market pricing look like for a June rate cut?
Yeah, that's right. I mean, it was fairly, I guess, dovish, the tone of the press conference. It looks like they're a bit more relaxed that about inflation. They kind of think the sort of stickiness of inflation pressures is starting to ease a little bit. So they are moving in the direction of rate cuts, although they're not sort of willing, to pre-commit to a rate cut at the next meeting or anything like that. They're just keeping their options open, and like you say, they'll see what the next couple of inflation prints are like, and then make a decision from there. But market's increasingly optimistic that the Bank of England is going to be cutting in June. Actually, there's a 60% price of that, a chance of that now priced in. And a sort of full rate cut discounted by August, which would be the meeting afterwards. So yeah, it looks good, and actually quite a big contrast to the situation in the US, where it's increasingly talking about higher for longer. It does look like in Europe certainly rate cuts on the way.
Okay, and then if we just look at the GDP numbers in a bit more detail, could you give us an idea? I alluded to them previously, just some of the main drivers, and March seem to be particularly strong. Is the moderation we've seen in inflation helping?
I think it is. I think it's helping people feel more confident and more willing to go out and spend. The fact that you've got pretty strong wage growth in the UK at a time when inflation is easing back towards 2%, I think is great news, and certainly will improve people's confidence. And like you say, maybe a bit of a boost for the Prime Minister as well. I mean, it was quite broad-based, the strength in the in the data. You had sort of retail sales, the service sector, which obviously the UK really does rely on. That was pretty strong. Investment was good, and manufacturing too. And as I say, the fact that the March numbers were so good suggests there could be a little bit of momentum as we go into the rest of the year. So after sort of several months or quarters in the doldrums, it does look like the UK is kind of heading in the right direction.
Yeah, so if we take the inflation mixed in with the better GDP data, do you think that Rishi Sunak might be inclined to call an earlier election than later on in the year?
I think he's keeping his options open. I mean, we'll have to wait and see what the polls like. I don't think the fact that GDP's had a good quarter is going to suddenly close the gap in the sort of Labour Party lead, because it is pretty massive. But it can't do any harm. I mean, I think he's got really a choice of sort of holding on until the end of the year and hoping something turns up, or trying maybe go for a sort of summer feel-good factor. Maybe if England win the Euros, he might be inclined to call an election straight after that. That would be a classic politician move. But certainly if we see another couple of good months of data and people start to feel better about the economy and about life, and the poll numbers improve a bit, he might decide that now is his best time to go ahead. So we'll have to wait and see. But yeah, let's stress still a big gap in the polls between Tories and Labour.
Yeah, I suspect it might take a bit more than some good GDP data. And if we then go across to the US, so last week we saw jobless claims tick up. And then if you couple that with the recent non-farm payrolls data and some of the survey data, I think the US Michigan survey for consumer confidence was out last week as well, which is a little bit weak. So it does seem we're beginning to see some of those cracks appear, and particularly in the labour market that the Fed would probably want to see before cutting rates. So what's your take on all of that data? And we might get a bit more colour as well this coming week with inflation and retail sales.
I think that's right, and it's weekly jobless claims. They've always got to be taken with a pinch of salt. You do get some regional distortions. This time, I think there was school holidays in New York, which allows sort of transport workers and various other people to claim jobless benefits when that happens, and that can push those numbers up. And we've seen it before. But I do agree, it's not just that. There are a few other signs that the labour market in the US is loosening at the margin, and like you say, the Michigan survey suggested that as well. So that's kind of good as far as the Fed's concerned in cutting rates, but they've obviously got the problem that inflation is pretty sticky, and we'll see what the prints are this week. But I think big picture, they're heading in the right direction in terms of getting rate cuts, but it's going to be delayed until later in the year, and it will be behind Europe and the UK probably in making the first move.
Brilliant. Thank you very much, Richard. And then Samir, if we turn to you now, thank you, first of all, for joining us. There has been a bit of a flurry, really, of M&A activity and bid speculation in the UK market of late, with the value of bids for London-listed companies this year hitting the highest level since 2018. So could you give us some recent examples for context? And also, is there a theme, or is it quite company-specific? And why do you think it's picked up so much? Is it valuations, interest rates?
Thanks, Jack. And well, after the glorious weather we had this weekend, the UK stock market is currently analogous to my afternoon chocolate treat, which, like a number of companies and market caps in the UK, was slowly dripping away in the heat. There's actually a triangle of factors at play here, including M&A, but also share buybacks and companies leaving the UK market. So to answer your question, 2023 was a very sluggish year for M&A activity in the UK, impacted by a rise in interest rates and risk-off sentiment. So last year, around 1% of the market exited via M&A activity. Now, this year, it's turned into a feeding frenzy, most notably by the private equity firms coming through. So if we look at it in more detail, in the first quarter of this year, there were 13 bids, including 7 in the FTSE 350 stock universe. Now, this has continued in the current quarter, with one of the largest being BHP's attempt to buy Anglo American. Now, Jack, you asked me if this is due to company-specific factors or is there an overriding theme? So if we look at the bids, given the differing sectors and market cap size of the deal, I think the most predominant theme covering all these transactions is simply how cheap the UK market is. So for context, the wider UK market is trading on a forward PE ratio of 12 times compared to the 10-year average of 14. That is substantially cheap. Also, the first quarter bids added up to a total of 17 billion, which is around 0.8% of the UK market. And if that pace of activity continues, technically the market could actually disappear unless we have new ideas and companies coming through to replace them. This is a theory of de-equitization that the UK market is going through at the moment. But in addition to that, we've actually seen 2 other factors at play in the UK market. Firstly, share buybacks. It often feels as if the daily RNS news flow coming through is about transaction in own shares. And some of these buybacks have a very meaningful implication on M&A activity. Barclays, for example, aims to buy back up to a third of its shares over the next 3 years. Scottish Mortgage announced a 1 billion sterling buyback program, and last week bought back over 300 million pounds in a single day, which makes it the largest ever buyback from an investment company. Lastly, you've also got a few companies simply delisting from the UK, where in particular they're going to the US to enjoy a high valuation, higher remuneration from top management, and a more liberal governance regime. Right. As such, all these factors could result in up to 15% of the market disappearing. Now, I see this as a double-edged sword. In the short term, these factors, like M&A activity, increase share prices and returns. But on a longer view, the market will narrow, detracting from choice and, of course, lower economic growth. As such, we see M&A activity as being bittersweet.
Okay, so that's really helpful context. So if we link into some of that, so these companies that are being bid for, are they companies that we would see held in client portfolios, perhaps across some of the collective funds that we invest in?
Absolutely, you're correct. And given that we aim to provide clients with exposure to some world-class investment professionals with an appropriate level of diversification, we have certainly benefited from that, from the recent activity. Specifically, over the last 12 months, we've had exposure to the likes of DS Smith, Wincanton, Gresham House, and Hotel Chocolat, to name but a few. In Hotel Chocolat's case, the bid from Mars was at an incredible 170% premium to the previous day's close. So absolutely, we are getting exposure to these type of companies.
That's great news for the clients. And then an area that we are quite positive on at the moment is smaller companies, both from a UK and global perspective. So can you give our listeners the rationale? Why now? What makes the space so attractive at this juncture? And why have they been out of favour historically? And what some of the risks around smaller companies?
Yeah, so in my previous comments, I alluded to how market returns in the short run were certainly benefiting from M&A activity and share buybacks. Now, for the time being, this has largely been seen in the UK large cap space, which is up 7% this year. Unfortunately, small caps have not been a beneficiary of this trend, and that part of the market is still seeing outflows and has returned just 1.6% year to date. And the A market, which is a smaller end of the market cap spectrum, is barely in positive territory. What is interesting is that we may be seeing some green shoots of recovery in investor sentiment. In 2023, we saw that in the small cap segment, if a firm missed its earnings expectations or undertook partial distressed capital raising to shore up their balance sheet, the market was punishing them severely. However, now we are seeing company performance stabilize, and bad news isn't being aggressively demerited from an investor perspective. Now, should this continue, and I certainly think it will do so, the simple act of there being more buyers than sellers should lead to attractive returns in the small cap space. Jack, you also mentioned things happening in the US. Well, that's another area where the smaller mid-cap sector is unloved and ripe for a period of strong relative performance. There is a risk, however, and the key risk here is that large caps continue to perform for some time before small caps catch up, and potentially having a decrease in interest rates might be the catalyst for us. So we'll have to wait and see, but certainly the opportunity is there for patient investors.
Yeah, agree. It's definitely an area of focus for us. So thank you to Richard and Samir for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now, wherever you're listening, and share it on your socials and tag us at quiltachieveit.com. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quiltachieveit.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website and on our social media pages. Finally, if you have any questions you'd like to ask our experts for our next podcast, simply ask them via the weekly comments page on our website. We'd love to hear from you. And that's it for today. So thank you again to Richard and Samir for your time, and to all of you for listening. See you next time.